So today's topic is about debt valuation, okay? And some important things that we will cover today is to give some insights about what debts is all about, okay? Which mainly we'll talk about bonds, bonds. So you will get to know what bonds is all about and how do we evaluate the value of the bonds. Okay, and also most importantly, we want you to be able to describe the key valuations or the key relationship between bonds and interest rate. So what factor might affect the values of the bond? So as you all know, as I've mentioned earlier in the earlier classes, okay, bonds is one type of debts, hutang, okay, and it's a corporate debts, hutang corporate. Okay, so what is a corporate debts or corporate borrowings? When a corporate borrowings, okay, when a corporations is companies. Normally, company borrows money, okay, with the purpose to finance its operation. And when they borrow money, it could either be in the two forms. Either they go privately or they go publicly. Okay, so when company needs money, they can go for debts. They can apply for debts. And there are two ways for them to apply for these debts. Either they can go for private borrowings or private debts, or they can go public borrowings or public debt. So looking at the word private here, private debts means it's between the company and one person, or between one company and one particular organizations or party. So it only involves two parties. Okay? That's why it's called private. While public debt or public borrowings involve a lot of people in the marketplace. Everyone can be the lender. Okay, if the company needs money, everyone can be the lender to the company, okay, and be part of the company. So let's talk one by one. What is private debt? So firms can raise money, okay, by selling debt securities directly to investors through a private placement. Normally, a private debt is an arrangement between the company and the banks. Okay, so one way to go for private borrowings by borrowing from the banks, okay. Other ways is by borrowing with other corporate organizations. Okay, rather than banks, okay, they borrow from other potential investors, and these investors are normally institutional investors. We call it institutional investors. Okay, companies, okay, that with a lot of money, okay, so they want to invest in anything. So these organizations can approach this company or another organizations and make an arrangement for a private debt arrangement. Okay, let's say for example, my company, company ABC, we need money to raise fund for our project. So we don't want to go for bank loans, but what we're gonna do is to go for another another private arrangement with another organizations. Let's say your organization, your company DEF. Your organization has a lot of money, and you are trying to find any potential investment opportunities. So my company will approach your company to borrow some money. Okay, this is what we call private placement. So rather than going to the banks, okay, we'll go make an arrangement with another particular organizations who interested to invest their money, okay, in the financial market, particularly through securities market. All right, so that is private debt arrangement. So the advantage of doing this private debt placement or arrangement, because of the speed, okay, it's very easy to arrange. It's between your company and the other company. It reduces costs. It offers a lot of financial flexibility. You can arrange on one-to-one, okay, how much do you need, how much interest rate they would charge, and so on and so forth. So it's very flexible. You don't have to follow many rules, especially when dealing with the banks. Okay, normally banks, they would do thorough checkup on your company, so it might take some time for them to approve your loan application. Okay, however, this advantage is sometimes it can be quite costly for companies to pay back their loans, okay, especially on paying the interest expense. Okay, this is applied if they borrow from the banks or if they borrow from other organizations. It can be very, very costly to them. All right. This about rate loans. We don't do this. Okay. And then the next choice, rather than going private, they can go public. Okay, so going public means borrowing the money from the public, from everyone. Could be from the institutional investors or the individual investors. So who are the individual investors? We all. If you have money, a lot of money, you want to invest in the stock, in the financial market, company can approach you, okay, to borrow money from you. So you are considered as individual investors. So this is what we call raising money from the public market, okay? And when companies want to borrow money from the public, okay, there will be one company who will act as the middleman, okay, that will help the company to arrange the selling and the selling of securities to the public, all right? So this middleman is what we call the investment bank. Okay, so investment banks normally will help to raise any long-term funds that represents the company in the public financial market. If you still remember, we have talked about investment banks during the week 2 of our lecture. Okay, firms and financial market topic. So we talk about investment banks. Normally, they are specialized and act as intermediaries that help companies to raise money, okay, and also provide advisory services, to giving advice, okay, to these companies when they enter into major transactions such as buying or merging with other companies, okay, and so on. So if company A wants to merge with company B, so they need a financial intermediaries called investment bank. So investment banks will give the advice what to do, what can't be done. Okay, so investment banks will help making these arrangements smoothly, right? And examples of investment banks in Malaysia, okay, these are some of the examples like Maybank Investment Banks, CIMB Securities, Investment Banks. So investment banks only deal with, helping companies and government to raise money, either in the stock market or in the debt market. Okay, and when company wants to merge with another company, they will provide the advisory services as well. These are among of the functions of investment banks, not just in Malaysia but globally. Okay. All right, and these are some of the functions of investment banks. First one is they do underwriting. Underwriting means they help the company to sell the security. Okay, let's say my company needs $1 million. So underwriting means this investment banker will give me the money first, will give my company the money of 1 million first. And then the investment banks will help find the buyer for the securities. Okay, so that's why they assume risk. They take the risk of selling the security on behalf of the company. All right, so the client, or AKA my company, is given the money before the securities are sold to the public. Okay, so that saves some times. Okay, so the investment bank give the money to the company first, okay, 1 million before they start selling the securities to the public. Also, investment bank performs distributing functions whereby they will sell securities to ultimate investors, okay, and also giving advice to the companies. Now, talking about bonds. So when you talk about raising money in the debt market, we usually, okay, especially in the public market, we usually refer to bonds, okay, selling through bonds issuance, corporate bonds. So what is a corporate bonds? It is a security sold by a corporation that has promised future payments and a maturity dates. So number one, bonds is a debt, hutang. Bond ialah hutang. Okay, and it is a long-term debt. Okay, it is a long-term that normally takes more than 5 years. Takes more than 5 years or more than 10 years. Okay, so it's a debt and it's a long-term debt, and it has a promised future payments meaning to say up to the certain years and end of the tenure, okay, the bond issuer, okay, will be given the payments, all right, at a certain amount, and also bond has a maturity date, meaning to say if a 10-year bonds, it starts from 2020 and will end until 2030. Itu maksudnya maturity dates. Unlike stocks does not have any maturity dates. Okay, if you are the stockholders, there is no expiry dates on your stock holdings. Okay, you can come and leave the company anytime you want. Okay, because stocks is not a loan. Corporate bonds has a maturity date. Okay, if you borrow from someone, you have time to pay until a specific time that you have to pay. Okay, so same applies. If I borrow your money, okay, and you require me to pay back your money in 10 days time, so that is our maturity period, okay, in 10 days time. So what if the firm fails to make payment? Now, since this is a debt, so it's a huge commitment for the firms to repay its debt. Okay, if they fail to make the promised payment, interest payments, and also paying the principal payments, then the bond trustee, or we call it as a bond, the bond holders lah. Okay, then the bond holders can classify the firm as insolvent and force it into bankruptcy. Meaning to say, the bondholders, okay, have the rights to list your company as insolvent. Okay, insolvent means gagal untuk membayar hutang. You fail to make the payments, and they can bring this matter to court, right? And they can file you for bankruptcy. So that is why it's very, very huge commitments if firms wants to get this source of money from the debt market, especially from the public market. Okay, because they really have to consider the implications should they not be able to pay its promised interest payments and also the principal payment. So these are some of the basic bond features atau ciri-ciri bond, right? The first one is bond indenture. So what is indenture? Basically, indenture is an agreement between the bond issuer and the bond holder. Let's say my company needs money, so I will issue bond. So bond ni will be issued in the form of in a piece of paper. Dia macam it's a security issued in the piece of paper saying that okay, we have raised bond worth $5 million to you, and you are the bond holder. If you lend your money to my company, lending your money means you buy this bond, this certificate, this bond certificate. Okay, so if you are the certificate holder, you are classified as the bond holders. Okay, so I'm the bond issuer, right? So basically you are my creditor because you lend your money to me. So of course, when we in the process of lending and borrowing money involve agreement, and that agreement is called indenture. Okay, so in that agreement or in indenture, it contains some specific instructions or terms such as the loan agreement, the description of the bond, what bond type is this? Because later we will discuss types of bonds. Okay, ada banyak jenis bonds. So it includes the description of the bonds, the types of the bonds, the rights of the bondholders. What will you get? Okay, as the bondholders, what are the rights that you entitled to? Okay, the rights of the issuing firms, what rights should I get? Okay, and the responsibilities of the trustees. So basically, indenture is a legal agreement between the bond issuer and the bondholder. Secondly, in terms of priority of claims on asset, all right? When you talk about if you are the bondholders, okay, in terms of priority of claims on asset or income, when the company makes money, before the company pays the shareholders, the company will pay you first, the bondholders first. Pay in terms of what? Your interest. Okay, so the company will pay your interest first. Okay, after the company pays all the expenses, kan, taxes. Okay, and you got the EBIT, kan, and then your earning after you pay tax, then whatever return that you get before you pay the shareholders, normally company will pay the bondholders first, pay the interest, okay? Because this is the main responsibility. So in terms of priority, you will get it first. You, the bondholder or the loan holder, you will get it first, your interest payment. Okay, and then after the company pays you, then only the company will pay the shareholders in terms of the dividends. Okay. Bond has par value. This is another criteria of bonds. Bond has a par value. The par value, or also known as a face value, nilai muka. Okay. It is the principal that must be repaid to the bondholder at maturity. Okay. Normally, par value of bonds is worth $1,000. Okay. Always remember the par value of bond is worth $1,000, and this par value are required to be paid to the bondholder at maturity. Meaning to say, at maturity, if the bond matured in 10 years' time, so in the next 10 years' time, this par value of 1,000 must be paid to the bondholders. Okay, next criteria is maturity and repayment of principal. The maturity date refers to the date on which the bond issuer must repay the principal. This is I have explained earlier. Okay, another criteria of bonds is that bond has a coupon rate. Now, what is coupon rate? Coupon rate is it's basically the amount of your return as the bondholder. Okay, this is the amount of the return that you will get as the bondholder. It is known as coupon interest rate. Okay, for stockholders, the return is in the form of dividend. But you as the bondholder, your return of interest return is called a coupon rate. Okay, so this will be your return if you are the bondholder. All right. Current yield is different with coupon rate. Current yield tells you how much return that the bond is making. Okay, so it's two different things. Okay, this is not your return actually, but current yield tells you in that particular year how much the bond is making profits. Okay, so it can be done through calculation like this. Okay. Another criteria of bonds, bond has a call provision. Call provision means if I'm the issuer, okay, and you borrow and you lend me your money for 10 years time, okay, let's say within the 10 years time, I wish to discontinue the agreement, so I can call back. Okay, I can call the bond back. That is what we call bond. Call means we cancel the agreement. Okay, so it offers the rights for the issuer, my company, to retire, to withdraw the bond before it matches. Let's say in halfway, okay, after 5 years, I wish to discontinue this bond, probably because I have enough money already, so I can retire the bond earlier. And of course, I have to pay you some amount of compensation, okay, for retiring the bond earlier. Next is to value the bond, finding the value, okay. How can we calculate the value of the bond? So just now, we have talked about the par value, kan? Bonds has par value worth $1,000, okay? So we want to check how much normally bonds is valued. And we want to know whether the bonds that you will issue later, will it be selling at higher value or lower value than the par value of 1,000. So this is what we are going to find out. So how can we calculate the value of the bond? Okay. So when calculating the value or the bond value, we normally present value, okay, the interest payment, and also we present value the principal amount of the bond. If you remember last week's topic, or sorry, chapter 5, time value of money. Okay, we have done on calculating the future value and the present value, and this is actually the formula to calculate the present value. Okay, right. So when you calculate bond value, okay, again, when you calculate bond value, we normally present value the interest payment, and also we present value the principal amount of the bond. Okay, and the formula is further translated into this mathematical formula, right? We present value the interest payments or the coupon payment. Actually, interest payment is your return as the as the lender. Okay? If you lend your money to the company, or if you are the bondholders, this interest payment or the coupon interest payment is actually your return. Is your return. So we, in finding the bond value, the first step is to present value this interest payment. Okay, present value, this is present value. We present value the interest payment, plus we present value the principal amount or the par value. Okay, we present value the par value here. So only two procedures when finding bond value. Again, the first procedure is to present value the interest payment or your return. Secondly, we present value the par value, the principal amount of the bond, which is the 1,000 just now. Okay, let's try one example. Calculate the present value of the 1,000 Mosaic bond if the bond pays 8% coupon rate, matures in 12 years' time, and the yield to maturity on comparable risk bonds is 12%. Okay, yield to maturity, or sometimes they call it as interest rate. Okay, interest rate is the market rate, what is being offered out there in the market. If you buy this bond, your return as the bondholder will be 8%, this coupon rate. This 8% will be your return as the bondholder. Whereas in the market out there, in the bond market out there, okay, they can offer you a higher return of 12%. This is what it meant by yield to maturity on comparable risk bonds. Okay, this is what it means 12%. It means in the debt market out there, okay, on average return, they can offer you 12%. But should you choose this bond to invest in this bond, you will only get 8% of return. Right? So I hope you can identify the difference there between this 8% coupon rate and also 12% of yield to maturity interest rate. So this is how it looks like. Okay, this is the answer, 752.23. All right. Now, how do you calculate? Okay, let me show you one by one. The first, calculating the interest rate. Now, when you know the interest rate or the coupon rate is worth 8%. Now, normally, the common mistakes that students normally did is that they put 8% here instead of 80. Now, when you calculate the interest payment, it should not be 8%. It should be 8% times the coupon rate. Sorry, it should be 8% times the par value of 1,000. Okay? Here. So 8% times 1,000, therefore, your annual interest payment is $80. Meaning to say, every year, you will receive $80 as your interest payment from the company. Okay, ini you punya income lah. By lending the money to the company, you'll get $80. So that's number one. When you calculate interest, make sure it is not 8%, but it should be calculated as 8% times $1,000. You get $80. So that should be the way how you calculate the interest here. Okay. And the principal is always 1,000. The par value is always 1,000. Okay. So 1 plus YTM. So again, YTM is the market interest rate, which is 12% given earlier. N is the maturity years of 12 years. And if you calculate this correctly, you should get the value of $752. Meaning to say, the bond value worth $752. So if you compare this bond value with the par value of 1,000, okay, meaning to say this bond is sold at a cheaper price, right? Because the par value is 1,000. Okay, but my company, okay, let's say I need money, so I issue the bond. The bond value when I issue to you only worth $752. It's cheaper. It's cheap. And any values that being sold below the par value is what we call selling at discount. Okay? So this bond is selling at discount. Why discount? Because it is less than the par value of $1,000. You follow? Right? So it's cheaper for you if you want to buy this bond. Now, one question, why it is cheaper? Why it is being sold at a cheaper price below the market value of 1,000? Because you only get 8% of return every year. Okay, if you go out in other instruments in the debt market, they can offer you much higher return worth 12%. Okay, but since you buy this bond, which only give you 8%, that is why the bond price is cheaper. Itu sebab harga dia murah. The same like you buy a phone lah, ataupun laptop. If you buy a low quality laptop, okay, it only can last like 1 or 2 years, kan? It won't last longer. So that's why the price is cheap. If you buy a much more higher and sophisticated specs of laptop, obviously it can last longer, like more than 5 years. But of course, you have to pay such a heavy price lah. It's quite expensive. So same things apply here. Why the bond is being sold at a cheap price, a lower price, because of the low return offered to you, only 8%, okay, as opposed to what being offered to the market, 12%. Another example. What if the bond pays 12% of coupon rate? Okay, and then the interest rate, okay, the market rate is also 12%. Okay, now same example, except the coupon rate is 12%. How much will be your the bond price? So if for this bond, okay, it should worth around $1,000. Okay, it worth $1,000 if should you buy this bond lah. All right. So meaning to say your annual interest payment, okay, previously it was $80. Now, if you invest in this bond, you will get $120 every year. Okay, and the market also, if you go to other markets, you will get the same amount of return. So that is why now the value of the bond has changed from 700 something to $1,000. The same value as the par value. Can you see here? Kan? The same value as the par value here. Now, why the value is the same? Now, why the value now same with the par value? Because you get the same amount of return. Doesn't matter if you invest in this bond or if you invest in the market, the price will always be the same. So that's the difference. Okay. So meaning to say this bond, if you buy this bond, it is selling at par value. Now, right, what if, a same example, what if this bond offers you much higher coupon rate worth 18%? So what is the new bond price? So this is the question where if you invest in this bond, if you're interested in this bond, you get 18%. Higher than what is being offered out there in the market, only 12%. Of course, this bond is much more interesting, kan? More attractive because it gives you higher return of 18%. Kalau you pergi tempat lain, okay, in other market only give you 12%. So that is what makes it attractive. So should you interested to buy this bond, you will have to pay around $1,371. Okay, it's much more expensive than the par value of 1,000. Now, again, why it is expensive? Because it is very attractive. If you buy this bond, you'll get much higher return worth 18%. Okay, as opposed to what is being offered to the market. If you go to other markets, they only offer you 12%. So that is why you have to pay higher price if you want to invest in this bond. Now, sometimes bonds are being paid, okay, the return or interest expense are being paid semi-annually. Semi-annually means in 1 year, okay, the company will pay your return twice. Okay, the first half of the year from January until June, and the second half of the year from July to December. So what if, what will be the value of the bond if the coupon payments and everything are being paid on semi-annually basis? Okay, how do you calculate that? For this example, calculate the present value of the 1,000 undo bonds if the bond pays 9% coupon rate semi-annually, matures in 10 years' time, and the yield to maturity is 15%. Now, if you remember chapter 5, time value of money, the concept is quite similar. When involve any kind of semi-annually payments or monthly payments, okay, the procedure are all the same. It's just that you have to divide and times some of the items from the formula. For example, okay, since your interest, okay, is being paid twice a year, 2 times a year, meaning to say the company is no longer pays 9%, because 9% if they are paid annually the whole year. But since this example, okay, they said that anything will be paid twice a year or on semi-annually basis. Therefore, you cannot use 9%. You will have to divide with 2, bahagi 2, because in 1 year involve twice payment. So you have to divide with 2. Therefore, your interest calculation here, 9%, you have to divide with 2, which is 4.5%. Okay, so for 4.5%, then only you times 1,000 of par value. Therefore, your interest payment worth $45. So $45, this one is on semi-annually basis. The first half of the year, the company will pay you $45. The second half of the year, the company will pay you another $45. That is what it meant. Okay, and same goes with the YTM here, the interest rate of 15%. You will have to divide with 2 as well. Okay, because interest is no longer paid annually but semi-annually basis, twice a year. So you have to divide with 2, and the N here, okay, is no longer 10 years because it's semi-annually, so it involves 20 times of payments. So you have to times with 2. So N, you have to times with 2, meaning to say 10, you have to times with 2. So 10 times 2 will be 20 times of payment. Okay, so you have to adjust this part. N times with 2, YTM divide with 2, interest coupon you divide with 2. The rest is the same, right? And it already have the answer there. If the bond is being paid, okay, on semi-annually basis, therefore the bond price is worth around $694. Now, talking about relationship with bonds, okay, the first relationship is that if you notice, in bonds, in bond market, okay, the relationship with the interest rate is quite opposite. It's not quite opposite, it's very opposite. Meaning to say, every time the interest rate increase, the bond price will reduce, and vice versa. If the market interest rate reduce, therefore the bond price will increase. That's the first relationship you can check between the bond price and the interest rate or interest market. Like for our example just now, we have noticed, okay, if like this one, if our interest rate here, the market interest rate is lower, much more lower than the bond price. Much more lower than your return of 18%. Okay, so when the market interest rate is low, normally the bond price is higher, it's expensive. This is the evidence. Okay, like this one. However, if the market interest rate or the YTM, yield to maturity, the yield to maturity or market interest rate can be considered as the same terminologies. However, if the market interest rate rises to 15%, like let's say previously it was 12, but now increased to 15%, and your coupon rate maintained the same, 12%. Okay, then the bond value will reduce. So that defines the first relationship between bond price and interest rate. Okay, when the market interest rate is high, the bond value drops, and vice versa. Now, why do you think this happens? Why do you think the relationship is negative? Okay. Out there in the market, okay, if you invest your money in the other instruments out there, they can offer you 15%, right? But if you wish to invest in this bond, it only gives you much lower return of 12%. So it makes the bond less attractive, right? It's less attractive because if you go out there, it will give you much higher return. So because of the less attractiveness, therefore, that's what makes the bond price reduce below par value. That's why the bond price is selling at cheap price. Okay, and vice versa, if the YTM, okay, is lower than the coupon rate, like our example just now, here, the market interest rate only 12%. If you go out there in the debt market, okay, if you invest in other bond instruments, on average they only give you 12%. But if you invest in this bond, it gives you much higher return of 18%. So because of this bond is very attractive, it gives you much higher return. That is why the bond price increased. The bond price is expensive. Okay. When the bond price is selling at expensive, higher than the par value, it means this bond is selling at premium. Selling at premium. Okay. When the bond price is selling below par value, like the first example we did just now, this one, 752, selling below par value, it means this bond is less attractive. Okay. When it is less attractive, okay, that's why it is selling at cheaper price or selling at discount. Okay. Why it is less attractive? Because why should you invest in this bond? Only give you very low return. If you go invest in other debt securities market, they give you higher return of 12%. Okay. So that's the reason why this bond is less attractive, and that is why it is being sold at a cheaper price, okay, lower than the par value. Okay, my explanation just now actually explains the secondary relationship. Secondary relationship tells you about whereby the market value of the bond will be less than the par value or selling at discount if the market's required yield to maturity or the market interest rate is above the coupon rate. Okay, and will be more than the par value if the market's required return is below the coupon interest rate, like what I've explained earlier. Okay. And the third relationship, okay, the third things that you need to know, relationship between bond price and interest rate is that as the maturity date approaches, therefore the market value of the bond approaches its par value. Okay. For example, if you bought the bond at discount, okay, meaning to say you bought it at $899. Let's say the maturity is 5 years. As it goes closer to maturity year, it will always go back to $1,000 of par value. The same thing if you buy at premium. Okay, let's say today you bought at 1,116. As years goes by and reaching to maturity period, the bond will always be at par value of $1,000. Okay, so that is what it meant by this third relationship here. The fourth relationship is that the longer term of the bond, the longer greater interest rate risk you have to deal with. Okay, so this is one of the risk if you invest in the bond market, especially when the term, the maturity date is longer. Okay, so you will have to deal with interest rate risk because interest rate is very fluctuates. Okay, it did not stays the same every year. So the longer the maturity, the more you are exposed to interest rate risk. And normally interest rate risk is very systematic. Systematic means you have no control of it. Okay, you have no control. You cannot determine, okay, I want this interest rate. No, right? You cannot control. That is what we mean by systematic. Okay, something like systematic is something like war. Okay, war in the Middle East, war between America and China, for example. Can you stop the war? Okay, so it's not that easy. All right, so it's something very systematic. Interest rate risk. Okay, it is something got to do with demand and supply. Okay, of the market. So the longer the time, okay, or the maturity period, okay, the more you are exposed to this the fluctuations or the uncertainty of the interest rate movements in the market. Many types of bonds out there available in the public debt market. I'm not going to talk everything. I'm just going to highlight few some of the examples like debentures. Debentures is one type of corporate bond. Debentures is unsecured. Is unsecured debt instrument. Unsecured means it's not safe. It's not safe. Company probably have problems. Not the ratings might not be that really good lah. Okay. Because of they are unsecured, the earnings ability is a great concern. Meaning to say, this company do not have the good record, okay, estimation to pay your return as the bondholders. Okay. Often the issuance firms attempt to provide some protection to the holders. Okay. So that's one type of bonds. It calls debentures. Second type is mortgage. Mortgage ni is much more secure lah, much more secure ataupun selamat. Why? Because it is being backed by the property. So should the firm fail to pay your principal payment or fail to pay your interest payment, therefore you can claim on the company's property or assets. Okay, any mortgage bond, secured by a line of on a real property, right? So ni apa ni bond yang ada cagaran lah, dipanggil bond cagaran, mortgage. So if the company fails to pay your payments, your principal payments, or fail to pay your money, okay, you have the rights to claim for the company's property or assets. That's what we meant by mortgage bond. So if the proceeds from the sale do not cover the bonds, the bondholders become general creditors, okay, similar to debenture bondholders. Okay, another type is Euro bonds. This is normally being issued by the European companies lah. And then zero coupon bond, zero coupon or very low coupon bond is a bond that doesn't pay any coupon interest payment. So not attractive. You won't get any return at all. That's why it called zero coupon. Or if they pay, they pay very, very low coupon interest payment, right? So consequently, bondholders receive all or most of their return at maturity, and because of they do not pay interest or sometimes pay little, okay, the price is selling at very, very discount. This is normally when the bond is a zero coupon. Normally, it is being sold at discounted price, less than 1,000. Very, very cheap one. Another type is junk bond or high yield bond. This is another type of unsecured bond. Tak selamat ni, a very dangerous one, because they pay interest rate 3 to 5% higher. They pay higher rate, but it's very risky. Okay, the investments that they will do involve a very risky investment. So that is why they are very high risk debt, or they call it junk. This junk bond has a very average or below grade bond ratings. And then floating rate macam tadi, floating interest rate tadi tu, it depends on the movement of the interest rate. And this one here are convertible bonds. If you want to invest in bond market, okay, and if you think that, oh, I want to have the features whereby I can convert myself from being a bondholders to the shareholders, so you can buy this bond. You can go for this type, convertible bonds. Kan. And normally these bonds, okay, the types that offered are very pelbagai in the market out there. Okay, it might be attractive, but it doesn't have this function of convertible bonds. So you ask yourself first, what do you want? If you want to have a invest in bonds that you can convert it later from bond to shares, so you should go buy this bond, convertible bonds. Okay, so convertible bonds are debt securities that can be converted to a firm's stock at a pre-specified period of time or pre-specified price. So normally, companies they will ask you, especially in times of the pandemic or economic very slow. So they probably ask you to convert yourself from being the creditor to the shareholders of the company. So it's up to you. If you want to buy this, you can go and search for these types of convertible bonds. Okay.